Now we are going to discuss about liquidity risk. So what is actually liquidity risk? At first, let us think about liquidity. What is liquidity? Liquidity is basically the ability to pay in cash, ability to fulfill the obligations by cash payment. That is basically the liquidity. So in case the Islamic bank does not have, either temporarily or quite permanently, if the Islamic bank does not have sufficient cash to meet its obligations or fulfill its obligations, then we can say that that can result in a loss situation, that can create an adverse situation resulting in loss of the Islamic bank. So basically, liquidity risk arises from the possibility that the Islamic bank will be unable to fulfill its obligation because of shortage of cash. Very simple. Okay, and this risk occurs as a consequence of the mismatch between the source of the fund and the requirement of the fund. You know that the Islamic bank will require cash, to meet its obligations. For example, deposit withdrawal. If the customers want to withdraw their amana, their cash, which they are entitled to do, but the Islamic bank does not have that cash, so they have failed to understand the requirement, or even if they have understood the requirement, they could not manage it because there is a mismatch between the source of fund and the requirement of fund. So what do we mean by source of fund? The sources from where the bank will get cash. So if these two matches, for example, the bank is getting $100, 100 taka, and also the cash requirement is also 100 taka, then there is no problem. But if the cash requirement on a single day is 100 taka, but the amount of taka coming in is only 70 taka, then there will be a shortage of fund, and the Islamic bank might not be able to fulfill its obligations. Okay. So what are the different situations that may result in this kind of adverse situation? It can happen due to defaults. For example, different parties are supposed to pay cash, but they default. Okay, so in that case, there will be a shortfall. And also, in case of Islamic bank, if the expected return, the expectation regarding the return is not fulfilled. For example, you have expected that you will get 20 taka out of 100 investment from an asset, but you are getting only 10 taka. So in that case, what will happen? You'll get 10 taka less. So your ability to fulfill obligation will reduce by 10 taka. So that will be the situation. And liquidity risk, it is not very common, that liquidity risk may create problem for different Islamic banks, but sometimes, when it happens, it is very serious. Liquidity risk is not very frequent, but it is very critical. It is very important to manage liquidity risk. This is why we'll also discuss about liquidity risk in a separate topic. So if an Islamic bank is exposed to high degree of liquidity issue or liquidity risk, it may trigger bankruptcy. You have to remember that.